But again, this is scary when we're starting to see this, what we call financial engineering happening. And I've called out Nvidia a couple times. I still think it's an amazing company, incredibly important part of the AI cycle we are in. But it's just telling you that we may be getting a little frothy. It doesn't mean we're at the end of the bull run, et cetera. We could run for a while longer, but it just means take caution, be understanding of what you're seeing out there.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. David, they just keep getting younger and younger. Claire and Kim join us in the studio today, our two newest hires. We're growing. Things are happening.
Well, sadly, Chip, you can combine their ages, and it doesn't even catch my age, let alone your massively higher age.
These people are even younger than my children. Yes. Oh, well, that's progress. That's progress.
Yes, sadly, I think that's the same for me. Damn.
Yeah.
We are getting old.
Oh, be careful. You're right on my heels, pal. Wow. We'll be celebrating your 60th soon enough. All right. In the meantime, hey, I just want to mention one more time, David, remind people, listen during the breaks, we'll give you the specifics, but we've got those two events coming up for teammates to recruit mentors. And as a matter of fact, you were at the tailgate party before the Nebraska-Michigan game at the Governor's Mansion, which featured teammates. Des Moines Adams and his team at Teammates were there at the event. And here come these events to recruit mentors, there are hundreds of kids, I think it's close to 1,000 in the Omaha and Lincoln metro areas waiting on mentors from teammates.
Yeah, these are fantastic events. Just find out what it's about. I think you're going to get a meal out of it. So
lunch and learn.
Yeah, we're going to have one October 1st right here at the Midwest Learning Center in our office. And then basically 2 weeks later down at Runza's national headquarters in Lincoln. So I can guess what you're going to be fed that day, October 14th. And you'll be in and out in less than an hour, and you're going to learn what it means to mentor. And just so you know, the whole mentoring program takes less than an hour a week. You do it on a public school site. You're really giving back to the community. And it's about 1,100 kids, last I checked, with Des Moines.
That's north of 1,000.
Yeah, okay. Between Lincoln and Omaha. And help them out, folks. Help us out. Recruit some mentors. It's a great way to give back to your community.
An hour a week for you, a life-changing impact for a young person. All right, listen during the breaks for the specifics. Into the news we go. David, Fox Business headline, business leaders warn Trump's $100,000 H-1B visa fee could hurt innovation, drive talent out of U.S. Even some of his allies are critical of this move. Now, the pro position is we want to attract top talent into the United States, so don't have these visas. The criticism is, no, we're undercutting American talent with cheaper foreign imports. It's a more sophisticated version of the argument we've sometimes heard in Omaha about the meatpacking plants that, well, if you offered a decent wage, you'd get Americans to work there. It's because we let you undercut it with, again, cheap foreign imports. How do you see it, David?
Well, these HB1 visas are not targeted at blue collar jobs.
They're high-tech jobs.
These are very high-tech, very specific skill sets that, unfortunately, American universities are not churning out qualified applicants for. So they're having to go to the Far East, in particular, in India, Malaysia, and they're bringing in talent from across the globe to do certain things. These are high-paying jobs. So, if you're like, hey, that's a fair tax or tariff. Now, I don't know if 100,000 is the right number. That seems a little steep because it could, for a smaller startup in tech, it could make them offshore those jobs and do them outside the U.S. borders. So, but I think there has to be some happy medium there where if we're going to bring in talent, exactly, then you have to pay for it. Of course, this goes back to the golden visa, right, which was going to be $5 million for entrepreneurs that want to become a citizen in the U.S. to protect their wealth. There's no stronger nation in the country, in the world that you can protect the wealth that you've garnered, et cetera. So, I'm kind of middle of the road on this. I don't like, again, it should have been forecast. What I have a problem with most of what the administration is doing is how they are communicating it. It seems too much from the cuff and not enough telegraphing because, again, I'm an entrepreneur. I'm growing a business. We have 2 brand new hires sitting in our studio right now. We're constantly hiring. I want to continue to grow, but it's very hard with the landscape going up and down and legislative and regulations changing on the fly when the very thing that Trump ran for, that I voted for, was deregulation and let the businesses figure it out, right? So, again, it's just they need to do a better job. And again, Ludnick and Navarro, those guys don't sell it very well, in my humble opinion. And they need to do a better job of telegraphing this information well in advance so it's not caught off guard or off by surprise, et cetera. But in the end, yes, I think there should be some kind of fee that they pay to the government to get those visas, to get the talent here, especially if you're going to replace an American worker. So now we've got some form of revenue that the American worker maybe would not be paying.
Well, speaking of placing a fee on foreign imports, here's a Reuters headline: U.S. lawmakers to introduce bipartisan bill to axe tariffs on coffee. There are two members of the House leading this bill. One is Democrat Ro Khanna from California. The other is Nebraska Republican Don Bacon. Don Bacon's saying that it's time for Congress to reclaim its authority on tariffs. Well, the Constitution does give Congress authority over tariffs, but then Congress in turn has granted statutory, through statutes, has delegated authority to the president in tariffs. So there is a legitimate debate about where the how far the president can exercise his powers on tariffs. Do you think this is going to go anywhere?
I think it will get some headway and some steam with the current political environment. And again, it is bipartisan, so we'll give kudos to that part of it. Again, Don Bacon is positioning himself, we know, for some future things at this point when he's not going to try to retain his current seat. And then people were bragging that, like, and Don Bacon's quoted in the interview, he did an interview along with a release article that, I had to pay like $4 or $7 more for coffee, and a couple of the Democrats. So one of them posted, hey, this bag of coffee is up $7. So I just went on Amazon and posted, well, here's the quote for me, and it's not up $7. So again, everybody's
a little fact checking.
Yeah, a little fact checking real time. But again, yes, I don't really like tariffs, but we have to have fair trade agreements that make it a balance correctly. So I agree, though. Congress should have the power here, not the president. And Rand Paul actually had, I think, the best logical assumption. The power, the president can have it for 90 days, and then Congress has to extend it 30 days at a time with a vote, or it goes away. In other words, and if Congress doesn't act, then the power gets to stay with the president. But I think Congress needs to step up. But right now, it's too partisan for them to really get anything done. And I don't like the idea they're going to target just a product, right? So what's the matter, Don? How much do you love your coffee? Maybe shop elsewhere. I don't know.
20% more, I guess they're saying, compared to last year. The coffee on the shelf, the $10 can costs $12 now, I guess is what that means, or something.
Well, again, if you buy in bulk, you can probably still get discounts. And again, I showed that literally with some of the people that had put some tweets or X out, or whatever you call it, X now. I still call it a tweet. But anyway, I mean, look, I think Rand Paul had the best idea here. Is Congress did abdicate the power, at least temporarily, to the executive branch, but they should claw it back after a timeline, and then we should have to have a vote to extend things or not extend them.
David, I want to shift gears to a CNBC headline because there was much ado about the recent rate cut by the Federal Reserve. But here comes a new Fed Governor, Stephen Miran. Well, here's the headline from CNBC. Fed Governor Stephen Miran pushes case for central bank to slash key interest rate. That's in addition to the recent reduction. In fact, he basically wants to see it cut in half, if I read the article properly.
Yeah, I believe we do what's called the dot plot after the Fed governor's vote. We plot out where they are forecasting the rest of this year and typically the next year. And most of the Fed governors see 1 to 2 more cuts this year and then 3 cuts next year. So that would be a total of 5 cuts. He's advocating for 5 cuts this year. Now, just so you understand, if the Fed were to cut 6 times between September and year end, that would be an outright panic to the markets. The economy is collapsing, and you would probably see some turmoil in the markets come from that. So literally, he's just doing Trump's bidding here. And again, I don't like this because he's the most recent governor put on the board, right? But it's like, okay, now you're just Trump's mouthpiece. I don't like it. I don't agree with it. And I don't think we need 5 rate cuts right away. I think that they were behind the curve. But I will tell you, the markets, again, like stability. Forecasts just tell us we're going to cut every month, every meeting. We are going to do a 1/4 point cut between now and next spring until we feel the data supports where we're supposed to be. But you cannot overreach one way or the other. You're going to create turmoil, especially in the bond market, which is significantly bigger than the equity markets.
On to a chart you shared with the team. This is from Jim Reed at Deutsche Bank, and it's talking about the relation of gold to the S&P and, some interesting numbers if you look back 20 or 25 years. Well, actually, if you go back all the way to 1980.
Yeah, so if you go all the way back to 1980, You've lost money if you've had all your money in gold. You've barely hung in there with inflation, where if you would have bought the S&P over that 45-year run, you'd be up over 4,500%, and it's got the exact percentage in the graph there.
4,250, 4,250%,
right? If you, though, the last, basically since the turn of the century, would have just went to gold, you would have outpaced the S&P 500.
Why?
Simply because the dollar has gotten significantly weaker. We've started printing money at an enormously fast rate. And that's all this is telling you, is that the dollar, again, is just a hedge against the currency you own it in.
Are you talking about things like quantitative easing?
Absolutely.
Okay.
And they're doing that right now. They're doing yield curve control through the backdoor process at the Fed and the Treasury, where they're not actually announcing QE, but they are, in fact, doing it. And all you have to do is look at M2, money supply, very easy graph to track how much money is in circulation. When a money supply goes up, if we don't have an expansion of goods and services, then the dollar is going to go down. It's really simple. And when you own gold, the dollar goes down, the price of gold goes up relative to the dollar, or relative to whatever currency you own it in. So the point I made when I sent that out is gold is a great asset. I just told the advisors this week in our Monday morning training, we're probably actually going to increase our allocation to gold. We have a portfolio we run called Smart CAR, and the CAR stands for Commodities, Alternatives, and REITs. And we think gold is likely to continue its rise in the near term. Now, I'm not advocating for you to go get one of these gold IRAs that are sold on the TV, because when you do those, they charge you storage fees, meltdown fees, all the kind. We've had a client that lost 40% when gold went up $600.
You've told that story on the air before, yeah.
Again, but it is a great asset to temporarily allocate to in times of when the dollar is weakening, which is what we think we have right now. Again, that won't last forever, though, and that's why you have to have somebody actively managing the portfolios.
Up next, digital currency, cryptocurrency. It's not going away. You need to be informed about it. Stay tuned for the latest news in digital assets from Retire Smart financial advisor Brad Starken. He joins us next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. As part of our continuing effort to inform and educate our clients and the general public on all manner of topics related to retirement, we bring you another conversation with our resident authority on digital assets. David, please welcome our special guest, financial advisor Brad Starken.
Yeah, thank you, Chip. Joining me in the studio once again is our resident authority on all things cryptocurrency, digital assets, advisor extraordinaire, Brad Starken. How are we doing, Brad?
I'm doing good, thank you.
I hear we've had some late nights with the little ones. That's some of the life of being a girl dad with a couple of little ones at the home. How old are your girls now?
Yeah, so 18 months and 5 years old, and my youngest Summer liked to grace us with her presence last night, so I think I spent more time awake than asleep.
Well, do your duty. It'll be gone soon. Enjoy every moment, because they get old fast, right?
That's right. That's right.
So listen, while you're coming in, we've got one of our digital asset classes become very popular coming up. We'll talk about that in a moment when that is. But I just want to kind of jump to, holy cow, this administration has gone all in on crypto, if you will. But the big news that I see is the Federal Reserve last week cut interest rates, and the concern there is, okay, we're cutting interest rates. What if inflation gets out of control? There's all kinds of scariness. The back end of the yield curve go up. But these stable coins, right, which are basically cryptocurrency backed by the U.S. dollar, could be a savior to the U.S. Treasury, right?
Absolutely.
Because if they're going to launch, and we'll talk about the value of the main cryptocurrency out there, Bitcoin, in a minute, how much is out there and how much is in these ETFs that launched, I guess, a year and a half ago. But if these stable coins really take hold, and it looks like they're going to, they are almost an unlimited buyer of long-dated treasuries, because they have to back up by they're backed by dollars, but they'll trade in value every day, but they're going to be backed by these treasuries. So if you have a guaranteed buyer, that may suppress yields, right?
That could very well happen. With all these stable coins that are coming out, typically they're going to be backed on a one-for-one basis with the U.S. dollars.
So if they bought a treasury that's already trading, if they bought on the secondary market at a discount because rates shot up here recently, and let's say they were able to buy it at 98 cents, but they back $1, that makes them have some reserve capital to go buy some more treasuries, right? I mean, so in active management, these things I think would be critical. But And again, let's dial back because I know I'm just jumping in here, but these stable coins are really going to allow cross-border transactions for international monetary exchanges. International shipments can get paid in a blink of an eye, even faster than that technically, right? Not instead of 3 bank wires around the world to make sure payment got done, and way less expense in accounting fees, et cetera, right?
Yeah, in theory, when you're looking at this, I mean, you're talking, you could potentially move millions of dollars for pennies on the dollar as it sits right now, and quite frankly, in seconds on some of these, which is where we need to be.
Well,
in the
efficiency is good for economic growth, right?
Yes.
Sometimes there's some disruption in there, and companies. I'm not saying it's these companies, but companies like Visa and MasterCard that kind of had a stranglehold on, financial transactions. They've been disrupted by companies like Square and Stripe, and this is just kind of taking that to the next step and facilitating transactions even quicker.
Well, quicker and more cost efficient, right? So, I mean, I'm even seeing it when we go to some local restaurants here, just in town here in Omaha, that if you want to pay with a credit card, there's a 3 or even a 4% credit card transaction fee that now
on top of a 3% restaurant tax that was supposed to be temporary. But I'm sorry, that's not our story today.
Correct. So all the fees, which we could do things faster, more efficient, and for less in fees, which I think would benefit everybody.
Well, yeah, because that makes companies have more liquidity, more profit, which means they can spend more money to grow market share, buy advertising, hire employees, whatever it may be. That benefits the economy. So in the end, that's a good thing, but there'll be some disruption. Some companies are going to be slow adopters and they may get left behind. We're not going to make those choices today, but so that's fantastic on there. Now let's flip back to cryptocurrency. So, well, first of all, the stablecoin ones, we're now having their first ETF for one of those that's tracking like XRP, I think, right?
Yeah, so that will track XRP. So that technically won't be a stable coin, but there's talks of that within the financial markets in that area. But, this is going to be a spot ETF. So there's a big difference when you start looking and doing research from spot ETFs
versus a tracking
to future
ETF,
trading
right? Futures
ETFs.
trading kind of tracking the volume, right?
The spot ETFs, which are, when we look at the Bitcoin and Ethereum ones, they're going to track that on a dollar for dollar basis. Now, the difference is the cryptocurrency markets trades 24/7, where our financial markets are just Monday through Friday, right? And from 8:30 in the morning till 3 in the afternoon. So obviously Central Time, but so they should track on a spot level as those kind of go up or go down through the course of time. But yes, looking right now is, XRP is going to be getting launched here. And it just shows that there's going to be a lot more adoption coming. And I believe, there's a lot more filings for other cryptocurrencies and digital assets out there to have these spot ETFs. Really just so you don't have to go out to either Coinbase or Robinhood to buy these individually, right, and have them on your own wallet and store those however you want to store it. This way you can actually buy it through potentially, whether you're at Fidelity or wherever you're at, you can actually buy those
right
in your investment
becoming
accounts.
So much more mainstream. I mean, that's the reality, right? Well, and we've talked about crypto for years because it's fascinated us. You and I have personally invested in crypto. You're way more active, of course, than I am. Of course, I'm still grateful once in a while you give me a little, hey, you might want to look at, but these are not the type of tools traditionally we're using for retirement planning for the majority of our clients, but we're able to get some exposure, and we've benefited greatly from that exposure when the SEC allowed the first launches of the exchange traded funds that are owning Bitcoin and Ethereum, et cetera, Bitcoin being the biggest. But now there's 12 of them. We tasked you when they launched. There were, I think it was 5, the original launch, and then subsequent ones to which one. And we liked Fidelity's just because Fidelity mined their own Bitcoin. They had the inventory themselves. It wasn't, but anyway.
Yeah, since 2014.
We're not making recommendations, but the 12 ETFs, this is valuable. You hand me a piece of paper before we recorded this. Those 12 ETFs, let me make sure I'm getting this right, are now owning 1.315 million Bitcoin. There's only 19 million Bitcoin available, right? Because there's going to be 21 million in the max, but the waste or whatever that was already gone, it's estimated to be about 19 million. Is that right?
Yeah, 19.8 so far has been mined, but there could be lost along the way.
So that's almost, 7%, just under 7%, if that my math is right?
Yeah, very, very close.
Of all Bitcoin is in these 12 ETFs, and they've only been trading for not even 2 years.
January of 24. So that's about $151 billion in this space, just in these ETFs alone, which is pretty fascinating.
That really is. I mean, well, that's just telling you how real the uptake of this is, and how it's going to have to be something that is in most clients' allocations in some form. Again, younger clients are going to be much more comfortable with this in reality because it's something they're seeing or doing or trading, et cetera. But you don't have to necessarily do this trading like on the exchanges like Coinbase, et cetera, which we do believe Coinbase to be a pretty reputable exchange where people do this. But you're now going to have this pretty regularly be part of portfolios you'll see when you work with independent financial advisors. I would assume we allocate a small percentage to it.
Yeah.
So if that really takes hold, because I think we're just in the infancy, then these numbers could get pretty. That's going to create demand, basically, which is going to keep that price at least some kind of level, if you will, under the bottom of that price. I mean, you track these prices pretty good. Bitcoin is 110,000 somewhere in there. I don't even know.
Yeah, right around 115 is what we're looking at, but definitely a very volatile asset. And this is I
remember it was like $114 when I first learned about it. I was like, yeah, that's not for me.
Yeah, but right now with this pro administration as it sits. Future, there's a potential for these options to be in your 401k allocations as well. Now, that doesn't exist today, but that's a possibility down the road.
Well, that's coming. They passed the act. They're trying to let what we call alternative investments, this would qualify under that have typically been withheld for what we call accredited investors. And just so you know, that means you make at least $200,000 a year or you have $1 million in liquid assets. That's the definition. But now if they're going to let this into the 401k, and there's good reason, by the way, to do it. The problem is I hope people understand how to risk allocate, and that's the scary part on their own, because this should not typically be the whole kit and caboodle, the whole shebang, right? There should be a small portion or allocation of that. But that is where wealth is created. Unique asset classes, truly diversified asset classes, and all kinds of alternatives. High net worth people, families that have more than 25 million, and I know that's a small portion of our audience, but we work with those clients too. It's over 53% on average of their investable assets are in alternative investments that are not liquid. They own hedge funds, private credit. They own cryptocurrencies that they don't need to worry about the day-to-day price action because they have more wealth than they're ever going to need for income. And so it allows them to, attribute more wealth. And if you're a fan of, pro sports, it's the same thing. And now private equity is penetrating professional sports in a very quick way. I talked about it last year. I bought an investment personally that gave me a sliver of the Buffalo Bills. And we're going to see more and more of that coming down the line because that's the only media, at least that's left on TV, in my opinion, that's really has value to it, right?
Yes.
And the Super Bowl commercials just keep going up in value for a reason. Those are eyes on. You don't watch the Super Bowl tape delayed. That's not like a DVR event, right? You kind of have to see it live because once the score's known, But so live sports are really, really changing the game and how media is delivered. And those are alt investments, just like these cryptocurrencies. And I think it's interesting if you go to most of these sports stadiums, they have Bitcoin ETFs now, right?
Yes. And
we have one or two here in Omaha, right?
Yes.
So, I mean, it's becoming a real thing. It's coming real adoption. All right, we've got a class explaining this and so much more on digital assets. When is that class?
It's going to be October 7th at 6:30 p.m. here at our Midwest Learning Center at our office here at Retire Smart.
You need to register for it, 402-369-7777, or just go to retiresmartnow.com and click on Attend an Event page. Look for the digital asset class and register because it is limited seating. Brad, I know we're out of time this week. Thank you so much for dropping in. I hope you get some sleep.
Thank you.
All right, Chip, back to you.
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go, David, and these are questions from our recent September Speaker Series event with Becky Swansburg, CEO of Stonewood Financial, on legislative risk, especially pertaining to tax policy. And the first question is about tax-free accounts. Are there other tax-free accounts in addition to Roth IRAs?
Yes, there are. And there's a myriad of ways you can receive tax-free growth or tax-free income, understanding how our tax code lays it out. So in addition to Roth IRAs, the most basic would let you know that there are Roth 401ks, right? They weren't always around. Very prevalent today, and over 88% of all 401ks in America now offer a Roth version. And this includes 403bs, et cetera. And in most recent legislation, we now actually have SEP Roth IRAs. These are usually for small employers or self-employed folks where you can actually do those in a Roth IRA, and you can put a much larger contribution into them, which means you can get dollars into tax-free accounts. If your 401k allows it, and only about 8% do, after you've max contributed to your Roth, and you have a catch-up contribution and two catch-up contributions that now have to go into the Roth when your income gets too high. When you're over 60 years of age, you get the catch-up. Over 50 and over 60, we have two new thresholds, so you can put more money away. And in addition to that, the after-tax contribution, you can make contributions into your 401k. It goes into an account that's segregated from your Roth and your traditional. And then if you follow the rules, that will roll into your Roth IRA at your retirement. Again, another way to compile tax-free assets. On top of that, if you purchase municipal bonds, if you live in a state like Nebraska or Iowa that has an income tax, you're typically going to buy municipal bonds issued from a municipality in that state because you do not have to pay federal or state income tax on the interest you earn. Now, interest rates are not sky high. However, if you have an effective tax rate of 31% or more in Nebraska, municipal bonds may make sense for you because the tax equivalent yield will outpace what you could get on a taxable equivalent investment. On top of that, Chip, you can do a myriad of tax-free investments through setting up proper trust work or setting up even specifically designed cash value life insurance policies. I do all of the above. Okay.
You don't know what you don't know. This is why you check with a professional.
Well, on top of that, under the tax code today, if you had non-qualified assets just in growth assets that didn't pay any dividends, you don't have to pay any tax on that growth until you sell said asset. You would pay what's called a capital gains tax. But under current tax law, a married couple over 65, their standard deduction, Chip, is over $46,000 with the senior deduction today. If they're over 65, you could actually go and have $112,000 of capital gains and not pay 1 penny in capital gains tax. That would be tax-free income if that was your only source of income and you wanted to sell off capital gains, have not a penny of interest from the bank, not turn on your Social Security, and you could get over $100,000 tax-free from capital gains. Again, you don't know what you don't know. So the answer is there's a myriad of ways to achieve tax-free or very low tax income in retirement, but it takes planning and it takes typically a couple of years of work. It's not like that.
Another Roth-related question, David. What are the chances of Roth accounts being taxed in the future?
Nil, zero,
well, the
nada.
government already taxed them on the front end, right? There's no way you could rationalize or legally tax it again.
No, and we've had our current tax code, or at least our current version of it, but the tax code in general the foundation was laid back in 1912, and never have we taxed assets that have already been taxed from a prior year. We only tax future assets. Now, may they cap how much someone puts in a Roth? May they tax how much you get into a Roth? The tax to get money in there may change? Absolutely. But once it's in the Roth, you are never going to pay tax on those dollars again. And only in the 138 years we've had the income tax, Chip, only twice have we actually changed the tax bill in the year. This was the third year, actually, technically we did it, because the tax bill must be laid out to the public before they can change it. And so even if they pass it a couple months later, it can go back to that day that they initially announced it, but never in a prior tax year.
Next question, David, is about IRMAA, income-related monthly adjustment amount, that nasty Medicare penalty that can bite people. And the question is, who are all the people affected by IRMAA? We just had a class on this recently.
Yeah, we just had a class
Smart.
this week. So I will tell you, it was 8.4 million senior citizens were affected by it last year. So basically,
better remind people what it is.
So basically, when you are receiving taxable income in retirement, Social Security, road retirement, pensions, IRA distributions, dividends, interest income, any of those sources are accounted towards your taxable income. And once you go over a threshold, currently about $106,000 for a single individual and double that, $212,000 for a married couple, you now have to pay a tax, we call it a success penalty, to access Medicare. And people are like, well, I'll just opt out of Medicare. I can afford my own care. You can't. When you take Social Security, you must take Medicare. You don't get to take one without the other once you're qualified for both, and therefore we can tax you. And the rate for Medicare, those penalties are going up at an average of 6.48% a year and have done that since inception, which was in 2004, put into law under the Bush tax cuts in 2004.
Boy, this is another example of why you want to have a chat with a professional so you don't run into this kind of a buzzsaw.
So where this catches people is married couples that are not over the threshold, but then we lose a spouse, unfortunately passes away, and the survivor ends up with all the same RMDs still apply, all the income. They just lose the smaller typically of the Social Security checks. And so they usually only lose 20 or 30,000 income, but maybe they had 150,000 in income. Now that survivor is over the IRMAA penalty line and sometimes is over 2 penalty. And there's 5 such penalty lines.
This sounds like another version of the widow's dilemma, where the
exact,
single
yes.
filer ends up in a higher tax bracket because you're now single.
And we
goodness.
show clients it can be between $60,000 and $150,000 over your lifetime retirement, just paying these penalties over and above what you're paying to access Medicare.
Yikes. All right, one more, David. Social Security. Will Social Security benefits be reduced in 2032 as funds run out?
If you believe the government, the answer is yes. I do not believe that. Again, the government's telling you that's what's coming. They are telegraphing it. It's on the letter out every year. If you log into your account, it says it clear as a bell. In the year 2032, we're going to reduce by an estimated 18%. The CBO says 17.2% the last I checked. So when we build plans out, we can literally build them out for clients and show them a reduction of their Social Security. Just cut it 20% in 2032. Are you okay? Because that's what you're really asking. Am I going to be okay? We can plan and show you if it even happened, would you be okay? And would you like to know the answer is yes or no? All right. And we can adjust your plan for it. However, politically speaking, I don't think anybody has the political brass to cut that.
Keep it clean for compliance.
To cut that benefit from one of the largest voting blocks in the U.S. history, which is mainly baby boomers, because you see behind it is my generation, Gen X, and we're less than half the size of baby boomers. So the pressure comes off in just about 16, 17 years from all these folks that are rolling on to these entitlement programs today, and we will ease the pressure. And then we have a much larger generation behind me, the millennials, over 95 million of them, that are now in their peak earning years. The oldest is turning 45 this year, and they're starting to earn real income, and they're paying more into the tax coffer. So we do have a problem to fix it, and politically it can be fixed, and actually we should simply move the age back. It's very simple. But I think the reality is to get the political solved, if we have people that will do bipartisan, we're going to means test, we're going to increase the income that you pay tax into the system, and then we're going to have to push the age back. It's going to be a combination of all three, and frankly, get it done. Just get it done and let America go back to stop arguing over something like this that's just math, but politicians like to use it to get reelected.
Up next, Omaha and Nebraska have been making the right kind of lists lately, and it happened again. We'll tell you about it next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, mediafeed.org, you shared this one with me right before we sat down to do the show. Oddly enough, the headline says, Retire Smart. 50 cities where $250,000 goes the distance. And the subheading, 50 ideal American cities for a comfortable retirement on $250,000 in savings. And coming in at number 16 was Omaha, Nebraska. Now, to give it its due, Des Moines, Iowa did edge in front of us at number 15. But I noticed, so in the top 10, there were a lot of cities in your old state of Florida, but then that next from 11 to 20, a lot of Midwestern cities like Omaha and Des Moines. Cost of living, housing market, healthcare access, transportation, cultural amenities, public safety.
Yeah, I've got a good friend that actually my brother Lou, who's our compliance officer, knows him as well. He was a runner, but he became a pastor at GW from high school, and he moved to Florida. And ironically, he lives now in the number one city on that list, which is Lakeland, Florida.
Oh, okay.
And Lakeland, Florida is basically inland, about 45 minutes or so from Tampa, right kind of in the center of the state. And that's what it talks about, the non-coastal cities in the southern states where it was much more affordable than, living, obviously near the beach, et cetera. So these cities that are a little bit smaller in size than the bigger cities offer all the cultural things you'd want, and literally people could retire sensibly with a couple of Social Security checks and a couple $100,000 in retirement assets. Now, that gives a lot of people out there, I hope that they can afford retirement, because some people come in worried so much, like, I know you work with people with tens of millions of dollars or millions of dollars, et cetera. I'm like, look, it's not about the dollar amount in your account. It's about the income that you'll spend and the affordability where you live. So this just goes to explaining the importance, Chip, of why you have to have an inflation-adjusted income plan to understand where your sources of income are coming from and how long it will last. And so I like, that's why I pulled the article, just to say that, right here in the Midwest, you can retire just fine if you're within reason of your expectations.
Well done, Omaha. All right, David, this chart you sent the team, I got a chuckle out of this. I haven't been involved in the Build-A-Bear phenomenon for a good 20 years or so. I think I think one of my daughters, either we had a birthday party there or she attended somebody's birthday party at a Build-A-Bear and they had fun. But you sent this chart with Build-A-Bear just shooting skyward. Who had Build-A-Bear as the hot stock tip the last 5 years? Not me. Retail's struggling, yet they post record revenue. What is this, just a one-off, an anomaly, or is there something to learn from this?
I honestly, yeah, it's not something that was on our radar. It just caught my eye, and I do a lot of scans on stocks every week, et cetera, and I found this one. This is Outperformed Nvidia, folks. So if you know anything about what's going on with Nvidia, this is amazing. So this stock went from basically sub $2 to about $76 in 5 years period of time. That's an unbelievable rate of return. And exactly what caught my eye is, like, we know what's struggling in this economy, right? It's retail has been struggling. Malls have been struggling in particular. Yeah. Closing. We've seen malls here struggle to get along. Yet Build-A-Bear, which has all their stuff built into the old-fashioned indoor mall, is skyrocketing, and they hit record revenues.
Build-A-Bear is bullish.
Well, it's interesting. I've never been into a Build-A-Bear. I've walked by them in a mall. It's been many years, but I know friends that have had their kids go in there, and they tell me you can spend $50 to $80 buying, building, and then accessorizing a stuffed animal. And what they're doing now is, they're selling like nostalgia bears, so that mom was the kid that, a mom today that might be 32 years old or something went there as a child.
Yeah, that's true.
And so now they're buying their kids one, and they're buying themselves one, so they're probably dropping $250 on stuffed animals. Now, that's not for me because my dog would have it gone in about 30 seconds. So, but anyway, I that was an anomaly, and not a recommendation, by the way.
Okay, all right, that'll make our compliance department happy. All right, hey, on to a little more serious topic now. This is from the Financial Advisor website. New IRS rules force high earners into after-tax catch-up contributions in 2027. There's a lot to unpack there. First of all, explain what it is we're talking about here, and then who is affected.
Okay, so when you're putting money away for retirement in your 401k, 403b, SEP IRA, et cetera, we have a limit of how much you're allowed to contribute to that on a tax-deferred basis, because the government wants to make sure they still get their fair share from you this year. So they limit how much you can defer. But once you go past a threshold, 50 years of age, you're allowed to do what's called a catch-up contribution. We introduced these years ago so that workers that felt they hadn't saved enough, if they chose to, could defer more money into their retirement accounts. Now, with the new rule, they're making you do that on the Roth side of the contribution if you're a higher income earner. And that threshold is currently set at $145,000 and will inflation adjust up from here. So if you make more than $145,000 to utilize these catch-up contributions, you may only put the additional contribution in the Roth side. Now, I argue you should be doing that anyway, right? If you listen to me for any length of time, because I do not believe you'll be in significantly lower tax rates, this myth that's been portrayed in America in your retirement years. So I think it's not much ado about nothing, but the reason they do that is they want to make sure they're getting the tax revenue now to pay for the most recent legislative acts that were pushed through Congress this past summer. So, and again, this applies to the over 50 and also the over 60, the additional catch-up contribution that was put through last year as well.
Boy, we seem to keep running into example after example of why you do want to check in with a professional.
Absolutely.
All right. Hey, you mentioned Nvidia just a moment ago, and you sent the team some information on Nvidia yesterday. Nvidia, this was actually, again, just before we sat down to do the show. Nvidia announced a $100 billion investment in OpenAI, so OpenAI could then buy $350 billion in future GPUs from Nvidia. We call this round tripping to make numbers look good. We know how it ends, as it always has before. We just don't know when. Okay, first of all, you got my head spinning with this. No wonder it's called round tripping. Can you break this down, slow this down, make sure we understand what round tripping is? And how is it that it always ends? I imagine badly, but
so Chip, you're company A, I'm company B, and you buy my product. So I'm going to invest in your company for growth, so that you're going to survive right now when maybe you don't have the revenues you need. So I'm going to give you a capital infusion and investment in your company. Now you have capital to turn around and finance and buy my goods and services that you buy from me. No. And the problem is it's not a dollar for dollar transaction. It's usually leverage. And in the example here is, hey, we're going to invest $100 billion. You're going to guarantee $350 billion back. But it's not really a guarantee. It's, hey, we're We're going to try and buy these from you if everything works out after your investment. We sustain
But you're
our
allowed
revenue.
to put it on the books so it looks good?
Correct. You can book this as sales. And so the example I gave, which we have on the screen, it's hard to see, but go all the way back to the .com bubble and go to big topic today, MicroStrategy. Michael Saylor fame is using Bitcoin instead of doing real technology, just buying Bitcoin, levering it, and then issuing bonds, and then buying more Bitcoin. He's round-tripping his own stock. Well, some of you might remember L3 Communications around these parts.
Yeah,
you may remember
3.
Nortel. All these cell phone companies and the early expansion back in the late 90s, they all did this round-tripping, and it made their future sales growth look incredibly sexy and and so we paid these ridiculous valuations for stocks, and that led to the .com
But the
bubble.
other parties didn't deliver.
Correct.
So you give me the
so if the
$100
economy
billion,
turns
but
and-
I don't end
Yeah,
up
there's
giving
no
you the
guarantee
$350
this
billion
really
back
happens.
over
Now,
time. Then you're
again,
left holding the bag.
So Nvidia popped when this news came out earlier this week, like $4 or $5 instantly. It was down basically the same amount the next day. But again, this is scary when we're starting to see this, what we call financial engineering happening. And I've called out Nvidia a couple times. I still think it's an amazing company, incredibly important part of the AI cycle we are in. But it's just telling you that we may be getting a little frothy. It doesn't mean we're at the end of the bull run, et cetera. We could run for a while longer, but it just means take caution, be understanding of what you're seeing out there.
We have a few seconds left to play with here at the end of the show for this week, David. Let's hit the teammates one more time. You said it's actually north of 1,000 kids. It's more like 1,100 in the Omaha and Lincoln metro areas that are awaiting mentors. It's only an hour a week. The
And that's
commitment,
including
that includes
your
drive time
transportation.
to the school where you meet the
you're
student.
literally probably going to spend about 40 minutes face-to-face with a child. But like you said, 40 minutes of your time face-to-face with that child, just letting them ask you questions. And some of these kids just don't have they have parents that just aren't available due to the demands of their work schedule. Some of them are single family homes that just don't have either father or mother figure in their home, and they just need to be able to ask questions openly from somebody that they feel confident and safe doing. And this gives them this opportunity, and it just helps mentor them understand how to do decision making. I mean, I think that's the biggest problem in our school system today is we stop teaching kids how to think. Critical thinking is the skill you need the most in life, right? Stop the participation trophy nonsense, and let's get kids to understand life is a competition. Once you step foot out of school, it's on, right? Your coworkers are competing for raises with you. If you're in sales, you're competing to earn sales, and that's how you earn a living in this country, providing good service and work. And so people need to have mentors that are in all facets and walks of life to understand life's struggles, right? We all go through the ups and downs of life, and just knowing someone's gone before you, which is, I will go back and give Joe Ricketts some kudos. Gave me some of the best advice of my life. Founder of TD Ameritrade. I got to be in a room with him 13, 14 years ago in a very small mastermind group. And he said, stop reading sales and marketing books, which I gobble down pretty regularly, and start reading memoirs and biographies. And you'll learn of people that you like and people you dislike, but you'll learn of their struggles and how they overcame things. And most people, it's just great advice. And that's what this is doing, is just taking the knowledge, your successes and your struggles, and transporting that into a young person, knowing it's okay. Because social media today has really challenged kids. They think that the world is just nothing but roses and for other people. Because what do you post on social media? You don't post the bad stuff. At least most people don't. But and so it just gives people a false sense of security, and it makes a lot of people get depressed, and anxiety's through the roof. We see this mental health. Anyway, it's a great organization. Step up, help us out.
Lunch and learn with us this week in Omaha or a couple of weeks down the road in Lincoln. That'll do it for this week. Please visit our website, retiresmartnow.com, and click Attend an Event at the top of the page to see everything we currently offer. No charge, no obligation for our events, but you must register. You can do it online or by calling 402-369-7777. David, bring us home.
Have a blessed and prosperous week. We'll talk to you next time.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.